All right, it's 10 o'clock, so we're going to jump in and get started. I know a few of you are still signing in, but we'll do some introductions and then jump right in. So thank you all for attending today. We're going to be covering understanding FAR overhead rates and audits. If we can project the slides and move them over, there we go. My name is Charlotte Roth. I am a CPA. I'm a partner at Danable and McKee, an audit partner particularly. We have both audit and tax departments here at Danable and McKee. I have over 23 years of experience providing audit and accounting and consulting services to a variety of clients, specifically architects and engineering firms. I have extensive experience performing federal acquisition regulation audits, otherwise known as FAR audits. I work extensively with New York State Department of Transportation, as well as other DOTs throughout the country, helping them as well as firms ensure that they are presenting their appropriate FAR overhead rate. Little bit about Danable and McKee. I mentioned we are a full service CPA firm. We deliver services, both audit and tax. We also have an accounting services department that works as from soup to nuts, from preparing bank reconciliations all the way to being an outsourced CFO. Our clientele consists of companies across New York State and throughout the United States, representing a diverse business enterprise. All the way from automotive clients and manufacturers to retail, and of course, our architects and engineers. We are headquartered right here in Syracuse, New York. We have offices scattered throughout New York, as well as Tampa, Florida. However, we perform services throughout the country. I have clients here in New York, all the way to Florida, California, and even Alaska. So we are very fortunate in today's virtual world to be able to service those clients very well throughout the country. We also have a sister firm, Danable McKee and Associates. We offer firms such as yourselves services to help value your business. We offer ownership transition classes and seminars, and we work with you to help develop your buy-sell agreements. We are actually offering some ownership transition seminars, and we will be providing these slides after emailed to you, so you don't have to write these dates down. But if you're interested in attending, we offer both full day and half day courses of these webinars, and this is going to really walk you through successful ownership transitions. I think this is one of the hot topics that all of you face in, as you're transitioning your business, and how to successfully do that. And we're going to help you through that process. So we're going to jump right in through talking about how to navigate through the complexity of what we call FAR overhead rate audits. So what we're seeing these days is there's more and more architecture and engineering firms that are in need of these FAR overhead audited rates. And that's because more and more businesses are doing business with state and federal agencies, and they are required to have if you're doing a cost plus contract, you're required to have what is called this federal acquisition regulation overhead rate. With the downturn that has been in the economy, I think you're seeing less and less private work, so more shift to the government. And with that, there's been a lot of work to ensure that government agencies, whether they're federal or state, are all operating on the same basis to help firms such as yourselves that you're presenting a FAR overhead rate, and it's consistent with, so that every firm is being expected to see the same thing, whether you're working with Arizona or New York State, or whether it's a federal agency like the DCAA, that they're accepting these FAR overhead rates. So we kind of defined FAR. It's called Federal Acquisition Regulation. You may hear that sometimes, but usually we typically say the word FAR. Keep it nice and short. We love our acronyms, don't we? So the biggest piece of FAR is what you're going to want to read for yourself is part of FAR Part 31. That's really the cost principles that are going to be directing you as part of what is part of this FAR audit. So the FAR in itself is 1,900 pages. It's a tough read. Don't expect that you'll read that. But that FAR Part 31 is only 50 pages long, very manageable. So it's definitely something that you and whether you're a principal or whether you're the CFO or controller, that is something that all of you should read and understand. That's really the guidance that you're following as part of this FAR audit. Some of you may have contracts with defense contracts with the DCAA or with the defense contracts, and then you may be audited by the DCAA. They have their own FAR principles guide, which is a great read, and their own manual. So if you have a lot of contracts, defense contracts, this is something you'll want to pay attention to. It's something we're very familiar with that certainly we can help you and guide you through, because while everyone wants to be on equal playing field between state departments of transportation and some of the authorities, the DCAA gets complex, and they do have their own auditors that will come in and audit your books and records. So it's just something you want to be aware of if this is the playing field you're in. So one guideline that we use quite frequently is called the AASHTO guide. So what does AASHTO stand for? It's the American Association of the State Highway and Transportation Officials. So way back in 2021, AASHTO created a subcommittee, an audit subcommittee that really created this guide. It's called a Uniform Audit and Accounting Guide. It's a great guide. It was designed to not only assist you as engineering firms, but to assist independent CPAs and state departments of transportation to really get on the same page of what it takes to prepare and audit a statement of direct labor and fringe, so your FAR overhead rate. So you'll see that this is something we refer to often if you are doing a FAR audit or if you're having a FAR audit done. So you'll hear that terminology a lot, and it's a great guide. There was a task force that met with engineering firms and CPAs throughout the country after this edition first came out. They've revised it a few times, with 2024 being the most recent revision. But the changes really that came out in 2024, really not applicable to what you're doing internally as engineering firms. There were more clarifications for us as auditors on sampling and things like that of what we should be paying attention to when we come through and do an audit. So the whole point of this AASHTO audit guide is really so that states give up their specific rules. So many states prior to 2007 really had their own specific guidelines of how they wanted what was allowable, what was unallowable. And it was very difficult for firms that worked across states to really get on the same page of what is included in their overhead rate and what isn't. So this is really to serve to get everybody on the same page. I'm not saying that some states don't still have their own little quirks and sets of guidelines, because they do. But this has eliminated a lot of that. As part of this guide, this was really to put a little bit more pressure on the CPAs that are performing those outside audits to say, hey, if you're following this guide, we're going to be able to rely more on these audits and then not have to go and re-audit the firms, which is great for the firms because when you go through a state agency audit or federal audit, there's a lot of requests. So hopefully if they can rely on the CPA's audit, then it's going to diminish the amount that they need to do on their end. So who is required to have a FAR audit? So this differs from state to state. It differs by agency to agency. Um, some guidelines, like in New York State, the New York State DOT, if you're a small firm, you may be exempt from a full CPA audit. However, what's a small firm? So in New York State, for the New York State Department of Transportation, that's only $1 million of gross revenue. So we all know it doesn't take much to get to $1 million of gross revenue. Most firms that do work with the state or federal agencies have to comply with this FAR audit. So when you're just starting to break into governmental work, this is something that you may see coming down your pipeline. Maybe it's not the first year of your firm, but certainly in the future. So there's new guidance came out for determining reasonable compensation. I think compensation is one of the biggest discussions amongst the FAR overhead rate. So I think this guideline really helps in honing in on what is considered reasonable compensation, which we're going to walk through in a lot more detail today. Recognizing the unique nature and complexity of FAR audit engagements, this guide really does help in that because it is very unique. Not every CPA firm out there can perform these FAR audits. It's something that you have to do a lot of research in. You have to really understand the firm and the nature of the firms and understand the guide. So it's not just a onesie twosie of you do these, we do a lot of FAR audits, and it's something you either do or you don't do. So determining your FAR overhead rate, it's obviously nothing new for engineering firms. I think most people have heard that term of an overhead rate, and you've been working on maybe creating your own internal overhead rate. And maybe the governmental agencies before have been accepting your own internal rate, but now you're stepping up into a larger contract. Maybe you're becoming the prime in the contract. So they're going to say, nope, now we need you to go out and get a FAR overhead rate. So I think that's very confusing to firms at times because there are a lot of nuances with FAR. So we as a CPA firm can help guide you through your first FAR audit to ensure that you've got the proper disallowances and that you're not leaving any money on the table. After all, that's the most important part. As a new agency starting out with a governmental work, you may get what they call an estimated rate, an initial rate. I don't want you to get stuck with this estimated rate. So think so much through this process, you're working on getting that contract, and you get locked in to this estimated rate because you don't have an established FAR rate yet. Take a pause, make sure that if you do get a FAR overhead rate within that same year, that you can go and change that rate and get that updated. I think that's really important before you enter into these contracts. If you are getting ready to get into a contract, contact us so we can talk about that process of how maybe we can do a FAR overhead rate before that contract is locked in and get you a accurate rate versus an estimated rate. Typically, those rates are right around 100%. That's what we're seeing as an estimated starting rate. Excuse me. All right, so overall, if you are at a starting point with a contract, just contact us and we can help you through whether that estimated rate makes sense. We can typically go through and calculate an overhead rate for you pretty quickly. It certainly wouldn't be a FAR audit, but we can look at your structure and walk you through and see. So we don't want you to get stuck with this estimated rate that they first present to you. One thing that we hear so often is, Charla, how can I maximize my FAR overhead rate? We hear so many people say this, and what does that really mean? And does that really even make sense? And now Obviously, it's critical that you're properly going in and calculating your FAR overhead rate, you're using the correct direct labor base, making sure that you're including all allowable overhead, that you're not disallowing any items that shouldn't be allowable, and therefore maximizing your overhead rate. And that's what I mean when you're maximizing your overhead rate. Because remember that if you have a cost plus fee job, you're only going to be reimbursed for the overhead. You're not going to be profiting on it. However, on some jobs, there may even be caps on that overhead rate. So incurring all this overhead just to maximize your overhead rate may not make sense because you may already be capped. You also could have some lump sums contracts in there. So any additional overhead is just going to reduce your firm's profitability. Keep in mind that it's your goal that you should always be in control of your firm's overhead and you shouldn't be incurring unnecessary expenses. So when people ask me, Charlotte, how can I maximize my overhead rate? I don't want you to think about maximizing your overhead rate. It's better to envision minimizing the disallowances between your actual overhead rate and your FAR overhead rate. And that is what we're going to work with you on. Another important consideration is how your FAR overhead rate compares to others in the industry. So we have a lot of resources that we use that could help compare your rate, because you may be pricing yourself out of the market if your overhead rate is too high. So we can be a useful tool to look at what some of the overhead rates are in your surrounding area and your competitors to really help you determine what some of the median rates are within your specific industry. So we utilize the source called PSMJ. Hopefully all of you have participated in a PSMJ survey. It's great. So it gives you a lot of useful information, such as it breaks it down, your overhead rates by size of your firm, geographic area. You'll see that the median rate overall is 187.2. That's a normal overhead rate based upon the entire United States. So when the first real step, if you are not already getting a FAR overhead rate audit completed, is really getting your internal financial statements set up. So determining an accurate FAR overhead rate is going to start with a formatted trial balance and internal financial statements. That might sound really basic and you may think that you're already doing that. However, almost every firm that we come into, we have some structural changes. We find that there's certain things are not being recorded correctly. Something that's really important that you are doing is establishing a chart of accounts that you are including billing and analysis of your job profitability, preparing effective internal control financial statements. And I think this is going to be really key too, is that within your chart of accounts, you're really breaking out your direct and indirect expenses. One thing that we see that firms really do not have a good handle on their labor charges. So whether they're recording direct labor and indirect labor properly, utilizing timesheets, that you're coding time to jobs properly. This is really, really important. And this is the first step at developing your overhead rate and ensuring that you're going to be compliant for us to come in and do a FAR audit. But most importantly, if say a Department of Transportation or the DCAA was to come in, they would be looking at your accounting ledger and ensuring that your direct costs are segregated. So some of your financial statements, your income statements might look like this. Your typical revenue, less cost of sales, is your gross profit, less your selling general administrative expenses. So this is like a normal commercial entity, a manufacturer. This is what sometimes we come in, and if you're using something like QuickBooks, this is what your income statement looks like. And this is really not a good representation of what an architecture or engineering firm should look like. This is a great example. So you'll see the differences. You've got gross revenue and this thing called net revenue. So you've got gross revenue on the top, and then you have to subtract out all your reimbursable expenses, your sub-consultant expenses, to come down to that net revenue number. So really, what's the revenue you're generating? That's the important number. And then you're backing out, then you're including your direct labor and your direct expenses. And that's really what's coming to your gross profit margin or your contribution margin. Okay, so that's just really important. And we have a webinar series coming up in September and October that I'm going to be walking you through your financial statements in so much more detail, how to structure them, how to read them, how to really make them useful for your firm. We're going to walk through ratios and, really digging into your financial statement piece. So, we'll send those dates out to you with these slideshows so that you can sign up for those, because it's going to be really helpful. If your financial statements are not set up looking like this, we're going to walk you through on how to get those set up. So then you walk through, then you've got your indirect expenses. So all your direct expenses are up above. Your indirect expenses, like your indirect labor, any office rent, depreciation, that's down below. But one thing that you'll see different is a lot of firms like to break out their discretionary items, things like discretionary bonuses or your profit sharing contributions. These are broken out because if you think about it, these are what they're called, discretionary items. So you really want to know what your operating income is before you make those discretionary items. So what is your firm, what's your firm's profitability before all of those items? So it's something to think about, whether you want to break those items out. I think it's really helpful. It's helpful to look at ratios because you may have a year where bonuses are very high. You want to make sure that you're comparing apples to apples. And so every year, if your bonuses are broken out separate, that's not going to be a reason why your overhead is showing differently. So we talked about the chart of accounts. Again, getting those formatted to allow for quick and efficient determination of your firm's overhead rate. So at any point in time, you should be able to just look at your income statement and determine what your pre-FAR overhead rate is. And over time, you're going to start learning what some of your disallowances might be under FAR, so that you're going to be able to make a quick calculation of what your total FAR overhead rate would be. So we've talked about this FAR overhead rate, and what does that look like? So when we come through and do an audit of your statement of indirect expenses, direct labor, and overhead rates per direct labor dollar incurred, this is what the statement's going to look like. So remember how we broke out all those indirect expenses? That's all that's going to show on here is your indirect expenses. You're not going to have revenue. You're not going to have direct reimbursables. That's not going to be on this statement. It's going to be your indirect expenses and your direct labor. And that's what you're going to use to calculate your overhead rate. So you can see in the first column, all of your indirect expenses, which are going to tie directly to your financial statements. And then you are going to see your direct labor. And then to the column to the right, these FAR adjustments. And we're going to talk about what some of these FAR adjustments are. Coming down to your final column on the right, which is your FAR overall expenses and your to create your FAR overhead rate. All right, so what are these disallowances I keep talking about? So in preparing for a FAR overhead rate, it's really important that management and the CPA understand cost principles under FAR. Okay, so under FAR, and you're required as management of an engineering firm to understand FAR. It's something we can work with you and teach you, but it's important that you understand what's considered unallowable. What's an unallowable cost? And it's really important, obviously, that the CPA understands. Now, obviously, I have the privy of seeing many CPA auditors issuing these FAR overhead rates through the work that I do with the state. And we can see many CPAs that just do not understand FAR. And unfortunately, these federal and state agencies come in and they know what CPAs are really good at this work, and they know which CPAs just are not familiar with FAR. And they are going to come in and do a lot more work to tear apart your FAR overhead rate audit. So that's why it's really important. And we're going to talk about what a qualified CPA auditor is, and certainly why Daniel McKee is the best one around. So this section of FAR really expressly dictates what's unallowable costs. So that's why I said that, what was it, 50 pages? That's a good read to understand what is unallowable and unallowable, what's allowable and what's unallowable. So determining disallowances under FAR. So FAR, while it's very long, it's very descriptive, it's also very gray. So this is what it defines as an allowable charge: something that's reasonable in amount, applicable to a government contract, compliant with generally accepted accounting principles, compliant with the terms of the contract, and not prohibited by anything in FAR subpart 31.2. Okay, so what does all of that mean? Reasonable in amount. I think we could all say every cost is reasonable, right? Well, here are some common disallowances under FAR. And advertising, bad debts, anything that's written off, contributions, personal use of company vehicles, fines and penalties, any lobbying and political activities, and interest expense. So what's considered advertising? So advertising is, if you're going to a trade show, that would be, having a trade show booth. That's considered advertising. If you buy polos and you have your logo on them, that's technically considered advertising. Now, sometimes you can consider that as a uniform, and then it would be allowable. But then there's things like business cards. Those are actually considered advertising. So when I think of disallowances, I always tell the people that I'm working with and firms that I'm working with that think about what reasonably the government's going to want to pay for. I mean, of course, they don't care about you going out and advertising your business. That's not a thing for them. They don't care. However, what you want to be careful of, it's not just advertising. So marketing, there's certain marketing that you may consider marketing, but it's not true advertising. So if there's bid and proposal time, that's allowable costs. So it's really important that you train your staff to understand what's advertising and marketing versus bid and proposal time marketing. That's allowable. So if they're preparing a proposal, that's allowable time. If there's any costs associated with that, that's allowable costs. And that's really important to understand. Bad debts. So if you have write-offs of customers, certainly they are not going to allow you to get reimbursed for that. Contributions. So if you make charitable contributions to, your favorite charity, they are say, great, but we're not going to pay you for that or reimburse you for that. So that would be considered an unallowable cost. Vehicles. So I'm going to touch on vehicles a lot more later, but vehicles is something that is a hot button point, and it's something that you need to consider. I think a lot of small firms include even large firms include company vehicles. However, they're not really looking at them from a personal usage standpoint. That's really important that you have a proper mechanism to track mileage and your trips in them. And we'll talk about that more in detail. Fines and penalties. So anything like IRS fine, unallowable. If you have late fees, unallowable. Lobby and political activities, certainly supporting any political campaign, unallowable. You have lobbying dues that you pay when you participate in ACEC. So those types of costs, unallowable. So right on the invoice, it tells you how much of that invoice is unallowable for lobbying costs. That would be something that would be disallowed. And certainly interest expense. If you have a mortgage and you have interest expense, that is not something that the government is going to reimburse you for. They are not going to pay for your financing from the bank. So many of these disallowances are very straightforward and really easy to apply. However, there's a lot that aren't. There's a lot of nuances. Interest expense, bad debt, contributions, donations, obviously very easy to pull right out of your general ledger and disallow. However, there's some things that may be a little bit more difficult that we'll have to work with you on. So we talked about advertising. So marketing. So marketing, obviously an unallowable cost, unless it's forbidden proposal costs. However, one thing that people forget is if you have a marketing director, those salaries are considered under unallowable costs under advertising promotion. So those are all costs that you need to back out. So if you have salaries and fringe from a marketing personnel, they hopefully are charging their time in breaking out, direct sales type marketing versus, attending or hosting a trade show. So it's really important that even your marketing department understands FAR and how they play a role in whether costs are allowable or unallowable. Vehicles. So if you have a company vehicle, it's really important that you're utilizing mileage logs to help minimize the disallowance for personal use. So it's really important that you are tracking your disallowances, or I'm sorry, your personal use, to ensure that you know how much of that vehicle is for business use versus personal. And the auditors are going to look at that. We're going to request those mileage logs. A lot of the time, if you're submitting direct reimbursement for mileage, you're going to be required to have those mileage logs for any of the state departments of transportation. And you're going to have to include details of the origin and destination. Those are all things that you're going to have to include on those mileage logs. So if you don't have a proper mechanism to track mileage, reach out to me. We've worked with a lot of firms that have that aren't really doing a great job at tracking their mileage, and we can work with you on how best to achieve that. And we can work with your employees to ensure that they understand why it's important. One thing we haven't talked about was travel and entertainment. So travel and entertainment are another area that gets really gray of, is it allowable? Is it unallowable? So entertainment, certainly not allowable. Holiday parties, unallowable. Travel. So it's really important that you understand your travel, because technically there's a lot of, you have to make sure it's under using an IRS reimbursement rate if you're reimbursing mileage. If you are taking a flight somewhere, you can't fly first class or business. It has to be economy. If you certainly choose to do that, that's fine, but it's going to be disallowed. If you are staying in a hotel, it really shouldn't exceed what they call the GSA rate, a governmental rate. That's something that you should be factoring in. You're gonna want to look at per diems to ensure it doesn't exceed that GSA rate per day. Those are all things that, as management of your firms, that you have to think about when it comes to travel. So another thing, so reasonable compensation. So we talked about how this is such a big piece of your expenses, labor, right? Labor is like the biggest piece. So in addition to the other expenses that we spoke about, something that's really significant is reasonable compensation. So in a firm such as yourself, you're responsible for preparing an analysis of reasonable compensation. Typically, this analysis focuses on your executive positions because those positions comprise of the highest compensated employees. So sometimes it's your top 5 employees, sometimes it's your top 10, really depending on the size of your firm. So FAR indicates that compensation for personal services is allowable subject to general criteria and additional requirements. So what the heck does that mean? So compensation must be performed by the employee in the current year and must not represent a retroactive adjustment of prior year salaries and wages. So if you have some sort of deferred payroll or bonuses that represent the prior year that you're paying in the current year, those are all unallowable under FAR. You have to compensate the employee in the year that they performed the service. So that's really important. So now if you're accruing payroll or accruing bonuses, that's okay because the expenses, you're accruing them and incurring them, and then you're paying them in the subsequent year. But as long as the expense falls in the right year, that's what's important. So the total compensation for individuals, employees, or job class must be reasonable for the work performed. However, specific restrictions on individual compensation apply when prescribed. What does that mean? Well, the compensation must be based upon and conform to the terms and conditions of the contractor's established compensation plan or practice followed so consistently to imply, in effect, an agreement to make the payment. Wow. So that's all wording of compensation. It's really complex within FAR 31. So one thing that's really triggered is bonuses. So something that you need to pay attention to is that you have a qualified bonus plan and that you have it in writing, and that you're sticking to it. So that you're communicating how employees can earn a bonus and that how they did earn that bonus and how it was communicated to them. So that's just really important that you have all of that in writing and that you stick to that plan. So FAR 31 does talk about allowability and reasonableness. So we're going to talk a little bit about reasonableness. Remember how we talked about the AASHTO guide? And it's going to provide you a step-by-step approach of compensation analysis. Factors to consider is the size of the firm, the industry, the geographic area, and whether there's private work or governmental work. There's a lot of compensation studies out there that you can follow. However, they've come together and put together this national compensation matrix, otherwise known as the NCM, to really evaluate the reasonableness of executive compensation. So rather than doing all this work to analyze your firm and compare yourself to others and really try to gather all this data, they did the work for you. And so a lot of us use this national compensation matrix to compare your reasonableness of salaries. So this is what it looks like. So it's based upon your gross revenue from your firm, and it's based on a title. So there's titles such as the CEO, CFO, senior vice presidents, HR directors, and then there's based upon your gross revenue, you plug it into this matrix, and then it posts what your max salaries should be for your level of firm. So in this instance, you'll see the CEO, he had a salary, she had a salary of $275,000, bonus of $65K, deferred comp, other compensation, maybe 401K, so a total compensation of $395,000. This CEO, she worked on some marketing activities, so we've already disallowed a portion of her salary. So we've subtracted $18,000 of her salary to come down to that $376,500. So that's the compensation that we're going to compare to the NCM. So she's making $376,000. However, the national compensation matrix for your level of gross revenue of 5 million says, someone of this stature, CEO, should really only be making $366,000. Okay, so that means we've got some excess compensation that we need to disallow, right around $10,000 worth. So this is widely accepted throughout the country by all the agencies. That's whole part of the whole AASHTO guide. Certainly, there's other exercises you could do to compare your rates to ZWAG and PSMJ. However, it's really difficult. You'd have to do that for every title. You'd have to compare it against multiple surveys. Every year you'll have to do this. That's why the NCM is great. Whether you feel that this is a true representation of what your firm should be capped at, take that up with AASHTO. We have certainly helped try to lobby for to push those levels up. ACEC certainly has helped in that area. But again, I think it's a survey from, whether you're a New York City firm all the way over to Alaska. So they're doing their best to try to really average out all those median costs. So some of you may have heard of this Bipartisan Budget Act. It was passed way back in 2013. And they said that for all these contractors, we're going to not only have you worry about this NCM, but we're also going to say, hey, we're going to put a cap on compensation. So in 2025, the cap is actually $671,000. Now, obviously, if your gross revenues at $5 million, you're not even going to come close to this in the NCM. But for really large firms that are, multi-state, you may have some top executives that are going to cap out at this amount. So you have to not only think about the NCM, but you have to think about this cap as well. So one other topic I want to talk about is this thing called the Facilities Capital Cost of Money. So otherwise known as the FCCM. So remember how we talked about interest expense, that it has to be subtracted from your overhead? Well, firms are actually allowed to calculate and add in an additional amount for the FCCM, which is determined on the average fixed assets used by your firm multiplied by an industry rate, an interest rate by the U.S. Secretary of Treasury. So although the FCCM generally is computed as a rate based upon indirect labor, the FCCM should not be included as part of your overhead rate, but simply a rate stated on your overhead rate schedule. So the FCCM can be part of your overhead charge to the customer if it's appropriately included in the terms of the contract. So you'll want to check that to see if an FCCM is allowed. And this simple calculation, and I included it here. It's your basically average net book value, and it's multiplied by a treasury rate. Excuse me. I'm having horrible allergies here in New York State. It's just been a really bad summer for allergies. So you'll take your average net book value, multiply that by an average treasury rate, that interest rate that we talked about, and that's going to be divided by your direct labor costs to get that FCCM that's going to can be added back to your overhead rate. All right, so something that we should talk about is direct and indirect labor. So when we are looking at indirect and direct labor, this is something that you have to have recorded correctly in order to get a proper FAR overhead rate performed. So while the FAR audit focuses on overhead expenses and disallowances, your firm is also required to have a project costing and labor charging system that's properly accounting for direct and indirect labor costs. So it's going to be super critical, and we will be testing it as part of a FAR audit, that your direct labor is the basis for the firm's overhead rate. And so to determine an accurate overhead rate, payroll costs must be correctly and consistently allocated between direct and indirect labor. A critical component is establishing and maintaining effective procedures for timesheet preparation, review, and approval. So it's really important that you, as the CFO, the controller, the principal, you're instituting a great procedure to all of your employees, your PMs, all the way down to your marketing personnel, that you're recording time correctly. So some people will look and say, oh, well, this might be a direct cost, but I can't bill it. So I'm going to put that cost in overhead. Well, that's not accurate. So if a time is charged and it's considered to be direct, whether it's billable or not. So if it's directly associated with a contract, it's direct time, whether you can bill it or not. And if you have some jobs that are lump sum and some that are cost plus, and you're like, well, I don't really care about the time for this, fixed fee contract. Well, you have to be consistent in how you're charging your time. So it's really important that you're instilling the process for your people that they're charging their time correctly and consistently. And we have come in and done a lot of work with firms to explain to your staff why that's important, how they charge time. It may require setting up more codes, and that's okay within your timekeeping system. Maybe you don't have a timekeeping system. We have walked into firms that have right at ground zero that have not had timekeeping systems that we've helped build timekeeping systems. So all of that is something that you're going to need to have in place if you're going to play in the governmental market. Accounting for overtime. So uncompensated overtime for salaried employees must be accounted for either by an effective rate method or a salary rate variance method. So if you have a complex accounting software such as like Delta Vision or Ajira, the chances are you're already using the salary variance method. So your uncompensated overtime is being tracked properly. There's some specific guidance also for overtime premiums. So consultants must maintain records that segregate overtime premium amounts and classify them as direct or indirect costs. Consultants must establish overtime policies that are applied consistently and result in equitable cost allocations. So you need to set an overtime policy, and that's got to be consistent throughout your whole firm. You can't set one policy for this contract and another policy for another contract. It has to be the same throughout your whole firm and for all contracts. Consultants must treat overtime premium costs consistently for all contracts. And I know there's some questions coming through. We'll see if we've got time at the end. If not, we will address all of those one by one. I'll contact all of you. We'll see how we're doing on time. I can see my time clicking away. I could talk about overhead rate audits all day long, but I won't. I'll just keep it to 1 hour for you folks. Office and field overhead rates. So you as an established firm may be asked to present an office rate and a field overhead rate. So what does that mean? So if you meet some size threshold, often for net revenue, then you start producing not a combined rate, but an office and a field rate. What's a field rate include? So if you do a lot of construction, contract administration, construction inspection, on-call engineering, you have contract employees, project offices in the field, that would be something that would be more designated to a field overhead rate contract. So you would need a specific rate for field jobs. In a field overhead rate, obviously they're going to be a little lower, the rate itself, because you're not going to have all the same costs as if it was an office or a home rate. Okay. So this is an example, and it's probably, it's a little complex, but just going to give you a sense. So you've got that your financial statement expenses on the left side, then you have all your disallowances, and then your indirect expenses in accordance with FAR. But then you've got this new segment here of what we call home or office rate, and then a field rate. So you'll come down and you're going to do an allocation based upon, maybe it's the direct labor charge to the field office. Obviously, you know who your field employees are. You can segment that time. So you can determine, for this instance, so 15% was allocated to field. Maybe some of maybe there's specific equipment that you're depreciating that's specific to field. And so maybe you're going to take that depreciation expense and allocate that specifically. But most of the time you're allocating it based upon a percentage. And then you come down to your overhead rate. You can see at the bottom, your field rate is 105 versus your home office rate's 136. Obviously, the field is a lot less because you're not absorbing as much overhead costs. So in this, we have talked about management's responsibilities for FAR overhead rate statements. So the AASHTO guide clearly indicates that you as management, you can't just rely on the CPAs. While I have so much knowledge to share with you, you've got to have your own knowledge and understanding of what's allowable and unallowable. When the New York State DOT comes to you and wants to audit your overhead rate or look at your overhead rate, they're going to look to you. They're not looking to your CPA. They want to know, does management understand their responsibility for identifying, segregating, and removing unallowable costs? Okay, you may not do all of that, but as long as you have the knowledge and ability to do it, that's what's important. All right, so we talked about identifying, segregating, and disallowing your costs. Okay, so you're going to work with your auditor on identifying those in advance. We're going to come through as auditors. We're going to audit your costs. We're going to find things that you may have not found. We find needles in haystacks. That's what we do. But if for the most part, you can identify those costs, that's what's important. That's what the guidelines are requiring. So even if a firm cannot always segregate its disallowances during the year, management yourself should be able to estimate your FAR overhead rate. So as time goes on, you're going to be able to understand what the disallowances are. And typically that percentage of disallowance every year is pretty consistent. If you're a firm that has an overhead rate of 160% and disallowances under FAR have averaged around 12%, you're going to be able to take your overhead rate. So if you're at 170 this month, you know you've got to deduct that 12% right off the bat for FAR. So you're going to know what that monthly overhead rate is, so that you kind of know where you're running month to month. You don't want any surprises. I think, we see firms get to the end of the year and they're kind of surprised by where they ended up. It really shouldn't be a surprise, guys. If you've got your financial statement structured properly and the FAR, there's no surprises in FAR. The disallowances are pretty consistent. You may have some your one-offs, but hopefully we're working with you to identify those throughout the year. Maybe you acquired a new firm. Maybe you sold off a portion of the firm. Those costs would be unallowable. Any legal costs or those types of costs to handle that acquisition. So those would be unallowable. That wouldn't be something you incur every year, but if it's something that, that happens that one year, that I got to consider that. So I'd be remiss to not talk about what it's like to choose the right CPA firm. So some of you on the call, I see you're already my client. Thank you for being here to support me today. Hopefully you're learning a little bit more from what I've already taught you. But choosing a CPA firm is really important in this process. You've got to make sure you're following due diligence before selecting a CPA firm to perform your FAR audit. And sometimes the firm that does your tax returns is not always the same firm that does your FAR audit. Sometimes we find that we're first hired on to do a FAR audit, and then they realize, wow, you guys really are experts in architecture and engineering, and then they bring us on to do the tax returns as well. So I think you've got to really interview your firms and make sure they have the right level of expertise, because FAR is a beast in itself. And if you do not understand this part of the regulation, you're way behind the field. And government agencies know what firms perform good FAR audits, and they know which ones do not. And they're going to scrutinize the ones that maybe are not experts in the industry. So it's just really important when you're selecting your CPA firm to take a look at that. It's really important that your CPA meets all GAGAS requirements. That's all something that's really important. These are all done under government auditing standards, that they've got a favorable peer review. That's so important to ensure that the person that's doing your firm, the firm that's doing your audit has a favorable peer review. And I'm going to show you what a peer review looks like, because you should request that peer review letter. They should have working knowledge of AE industry. So often we take over firms that their financial statements are not in any shape or form of really being able to analyze your firm. You're special, you're unique, you're a professional service firm, you're not a manufacturer, you are not a retailer, you are special, and you need to have your financial statements structured in that means in order to help you succeed and ensure you're making a good profit. Job costing, very important. It's a very unique industry. The software that you're using, all very unique. So having a firm that understands that software is important. So I talked about a peer review. So this is what a sample peer review letter looks like. It's not a sample, actually, it's ours. So Danville McKee, we're audited by a national peer review committee. So we ourselves are audited, and we want to make sure that as auditors or as a firm, you're hiring a firm that has a positive report on themselves. You want to get someone who has what is called a clean peer review report. And this is what a clean peer review report looks like. So really important that when you are interviewing a CPA firm, that you ask them for their peer review report. It's a very simple request. You would be surprised at how many people are trying to do audits that are actually not even compliant to do audits. It's shocking to me. In interest of time, I'm really going to go through this quickly, but audits, FAR audits are a challenge. They're expensive and costly. There's no way around it. You may think, oh, it's just a matter of putting in your indirect costs and disallowing a few items. Well, that's not. We have extensive testing that we're required to do. We have to look at timesheets and audit your internal controls. There's a lot that we have to do. There's a lot of forms we have to fill out just in order to issue an opinion. So FAR audits, yeah, they're cumbersome for us to complete, which is why they're expensive. So it's a burden that these are placed upon the firm, but you have to understand when we come back and we give you a quote, we have a lot we have to achieve in order to issue a FAR audit. It's complex in nature, and we explain all of that. It's a lot of work in order to get that one sheet of paper that you need in order to be certified. A FAR audit, like, what does it take? So if you called me today and said, Charla, I need a FAR audit, how long is this going to take? So a FAR audit for a small to mid-sized firm is like 100 to 150 hours. So audits, obviously, of much more complex entities are going to require more time. We have FAR audits that take 500 hours here at our firm. So big range depending on the complexity and, how many states you operate in, how large you are. Also, how organized you are. So are your books and records, are you already recording direct and indirect costs correctly? That's all really important. All right, we have to perform a lot of substantive tests. So we're going to be asking you for receipts. We're going to ask you for invoices. We're going to ask you for timesheets. We're going to ask you for so much. So be prepared for that when you're coming upon your first audit. And again, what are we trying to achieve? This is a sample FAR audit report that we're going to issue. We're going to also issue an internal control and compliance report. This is really important. So if you're going into a FAR audit and you're not properly segregating your costs between direct and indirect, that's going to be a weakness that we're going to have to report in your compliance report. So typically, if you know you're going to need an audit report in a year or so, you want to contact us now so that we can work with you, so that we can get your books and records, work with you to get your books and records compliant, so that when it comes time to do a FAR audit, you're not having a deficiency reported on this compliance report, which this compliance report, most state agencies request a copy of it. And this is a sample of that report. And again, I'm going to send you all these so you can read through these in a little bit more detail. So I'm going to conclude because I see we are right at the 11 o'clock hour. Like I said, I could talk about this all day long, but I won't. Performing services for government clients can be very profitable for you as a firm, but there's a lot of complexity. So hopefully you've learned a little bit more about FAR overhead rates, what they mean to you for your firm, and that Daniel McKee, we're here to help you. Please reach out to me. I do have 2 more webinars I'm teaching. I think it's September and October. We'll get you those dates. That's going to walk you through your financial statements, making sure they're structured properly. You know, we talked about government or generally accepted accounting principles. It's really important that you know, if you're a cash basis taxpayer and your books and records are on a cash basis, like your tax return, that's not appropriate under FAR. So we'll work with you to get that converted. So if you think that you're going to be entering the government space or you're growing as a firm, you know, we can help work with you to get your books and records ready to be FAR compliant. I think that's a lot. So we went through a lot. I see there's a lot of questions. So I'm going to address all those questions. I'm going to email you all individually. In this is going to be my contact information. Email me with questions. I'm here to help you. Call me. I really appreciate your time today. FAR is an awesome environment, and don't be scared of it. Hopefully this webinar today really helped you understand it a little bit more and opened you to the world of it. If you're already in it, hopefully you took a little deeper dive today. But again, here at Daniel McKee, we're here for you to get you through that next step. So again, thank you all for participating, and hope to hear from you soon. Thanks.